Morning, guys. Today we are going to look at stock valuation as it is asked in question 2 of your sample assignment 1 for ICB cost and management accounting. So let me start by just sharing my screen here. Okay, so that is the information that is given. You get a little table, and in the table they give you dates, they give you what they call action, they give you the number of units and the price, and then they say use the table, this table, to calculate the amounts using the perpetual weighted average method round to 2 decimal places. So they're telling us which inventory valuation method to use. It is the perpetual weighted average method. And then using that method, we are supposed to calculate a couple of things. Firstly, the closing stock, then the cost of sales, then the sales, and then the gross profit. Okay, now in your answer book, what you will find is that they give you a little table like this, where the headings day, purchases, issues, cost of sales in brackets, and balance. And this table we are going to use to calculate the closing stock. Okay, so let's start. What do we know? We know that on day 2, there we have no purchases, we have no issues, but we have a balance of the previous month of 218 units in our storeroom. Okay, so that is what we have on hand. Then on the 8th, we go and we buy an additional 305 units. Okay, so if we had 218 and we buy additional 305, it means that we now have 523 units on hand. So then what happens on the 10th is that the sales department makes a sale. And when they make the sale of the 349 units, we must issue them with those 349 units. Okay, so those units are leaving our warehouse and we are now left with 174 units, simply subtracting the 349 from the 523. Okay. Then on the 14th, we buy new stock. Okay, so we make a purchase. And we see how many we are purchasing. We are purchasing an additional 436 units. We add that to the 174. And now we have 610 units in our storeroom. Okay, so we go on the 21st. Once again, there is a sale. When there is a sale, we must issue the number of units sold to the sales department for distribution. In this case, it is 458 units, leaving us with only, as you can see there, 152 units. Now, every time we make a sale, we see that it's way more than 152, and we don't want to be caught out. So soon after that, on the 25th, maybe after the weekend, don't know, we purchase an additional number of units. In this case, we purchased 262 new units, and that gives us a new balance of 414 units in our warehouse. On the 27th, same thing again. We have a sale. Okay, if there's a sale, we at the warehouse must issue the sales department with the number of units that they sold. And we then must subtract that from the units on hand. And now we only have 131 units in our warehouse. And we are a little bit worried. We say we don't want to start the new month with only 131 units. So on the 29th of the month, we go and we purchase for the last time this month an additional 327 units. And we end the month with a closing stock of 458 units. And that is exactly the first thing that we were supposed to calculate. So that was easy. We've calculated our closing stock. Now, in the information given, just go back a little bit. You will see here that every time they give us a price. Now, this price that they give us in the table is the unit price of that stock item. So what that was telling us is that what we have on balance, that 218, is valued, okay, at 291 Rand a unit. That is what we value it at. So every time we make a sale, we will take the sales price, multiply it by the number of units, but then we'll also have to look at the price that we have, the cost price that we have for the stock that we have on hand, multiply that by the number of units sold, and that will become our cost of sale. Okay, so what I have now done is I've taken these numbers that was given here as the price, and just in order to make life a little easier for myself, I create a new little table here, and the first order of business that I have in this new table that I'm creating, you don't have one like this new answer book, but it's way easy to do it this way. So I suggest you draw a table like this. So I take the given prices and I just put them in this column here so that it's easier for me to work with them. Okay, so I don't have to go scroll back every time. I am basically continuing the table using the balances that I've just had, and I transfer the prices. Okay, so now what do I see here? I can see that if I have 218 units in the warehouse and they are valued at 291 Rand and 56 cents, then I will multiply the 218 with the 291, and I will get my total stock value. Okay. And that'll be 63,560. Now, in this case, I've created a new column here, and this is the unit cost that we value our inventory at. Remember, this is what we are busy with. We are busy with inventory valuation at the perpetual weighted average. So this is what this means. Unit cost at perpetual weighted average. These are the only stock units that we have at this point. So there will be no change in the price. It will simply bring in the 291.56. Nothing will change. Okay, but now something happens. Okay. On the 8th, we are buying an additional 305 units. Okay. And we are buying those 305 units at 320 Rand. Okay. So what do we need to do? We need to say, okay, take the 305, multiply it with 320, and then when you get the answer, add that to the stock value that you had before you made the purchase. Okay. And so that is what we do. We take the existing stock value, and to that we add 320.7 multiplied by the 305 units. And when we do that, we get a value of 161,379.68. Okay. So that is our stock value. But now if we use the perpetual weighted average as our method of stock evaluation, we now say, okay, if that is our stock value, let's take that stock value and divide it by all the units that we have on hand. And all the units that I have on hand is 523 units. So I say 161,379 divided by the 523 units gives me a unit cost of 308. And I know that I'm right because it must be somewhere between 291 and 320, and 38 is somewhere in the middle, so we are happy. Okay. Then we see that on the 10th, we make sale, okay? And we are selling 349 units, okay? And those 349 units, we are selling at the price of 1,166 each. It looks like we have a markup policy of about 60-65%, okay? But in any case, our sales will then be that unit price, unit sales price now. The other small amounts here are cost, and this is a sale, obviously. The sales price multiplied by the 349 units will give me my sales, and that is a nice sale of 407,000. Okay, so far so good. Now we say, okay, but every time we make a sale, there's also a cost of sale. So what is our cost of sales? Well, it's easy. We say what we do is we take these number of units that we are selling, and we multiply it with the current value of our units. Okay, so currently we value our units at 308, and we are selling 349. So our cost of sales is 308 multiplied by the 349, and that gives us 107,000 rand. Okay, so what is our stock value now? That's simple. Our stock value is now simply what we was before, 161 minus the 107, which is 53,000. That is our new stock value, and our unit cost does not change. It never changed when we make a sale. It only changed when we make a purchase. Okay, so then we make a purchase again on the 14th, and we purchase 436 units at a price of 349.87. Okay. So what do? We take our existing stock value, the 53,690, and to that we add 436 multiplied by 349. And just remember, like always, multiplication comes before addition. So we do this first, and then we add the 53,000. And when we do that, we get an amount of 206,233. That is our new stock value. So we take that stock value, we divide it by all the units that we have on hand, the 610, and we get to a new stock value here of 338 Rand per unit. We check it again. We know that it must be somewhere between 308 and 349. It is in between, so we know that our calculation was correct. Okay. Then on the 21st, we are making another sale. Okay, and this time we are selling 458 units at a selling price of 1,195. So what we do, we say, okay, let's take that unit price multiplied by the 458, and that will give us our sales. Okay, nice sale of almost 550,000. Okay, so now what will our cost of sales be? Our cost of sales will be that same number of units, the 458, but now multiplied with the unit cost as we evaluate it. So we say it is 338.09 multiplied by the 458 gives us a new amount, and that amount is almost 155,000. That is our cost of sales. Okay, how do we calculate our new stock value? Well, it was whatever it was before minus the cost of sale. And once again, our unit cost of our inventory does not change, stays at 338.09 Rand. Okay, and so you're now used to it. We make a new purchase on the 25th. We are purchasing 262 units at 379 Rand. Okay, So what do we have to do? We have to multiply the 262 with the 379. And then when we get that answer, we must add that to our existing stock value of 51,000. And when we do that, we get a new stock value of 150,000. Okay, so we take that stock value, we divide it by all the units again that we have on hand, the 414, and we are expecting a number somewhere between 338 and 379. Okay, little closer to 379 because we bought more than what we had on hand. And when we do that, we get an amount of 364 Rand. That is now the new stock value using the perpetual weighted average method. Okay. Then again, for the last time in the month, on the 27th, we make a nice sale. We are now selling 283 units at a sales price of 1,224 Rand, giving us a sale of 346,000. Okay, that will imply a cost of sale. The cost of sale will therefore be that same 283 units multiply by our current unit stock value of 364, and it gives us a cost of sale of 103,000. Okay, the stock value will now simply be what it was before minus the cost of sale, which is 47,000. And now we say, okay, let's see how many we have left. Not yet, sorry, but we know is when we make a sale, our unit costs valuation does not change. So we simply put that in. Then the last transaction that we have is the 327 units that we are purchasing at a cost price of 408 units. Of 408 Rand rather, sorry. So we multiply 327 with 408. We get the answer, and we add that answer to the 47,000. And when we do that, we get a new stock value of 181,000. We take the 181,000, we divide it by the number of units that's in our storeroom now. We're expecting, once again, a value somewhere between 364 and 408. A little closer to 408, once again, because we bought more than what we had on hand. And when we do that, we get an amount of 395,000, which is somewhere in the middle, and we're happy. We know that all our calculations were correct. Now, that hasn't answered any of the questions yet. What we are supposed to calculate is our cost of sales and our sales. So the way to calculate our cost of sales is to add these three amounts in the cost of sales column. And the way we calculate our sales is to add the three amounts in the sales column. Okay, and now we can see that our sales for the month was 1.3 million, and our cost of sale was 365 million. And we know that the gross profit is the difference between our sales and our cost of sale. So we simply subtract the 365 from the 1.3 million, and we get our gross profit. Our gross profit for this month was close to 1 million, was a good month. Okay, and that is how you use the average, the perpetual weighted average method to calculate your cost of sales in each case, to calculate just your stock value, and then ultimately to calculate your sales, your cost of sales, and your gross profit. Good. I'm going to stop sharing, and I thank you, and I will speak to you when we do the next lesson.